Hello, this is Rob Carrig with Carrig Wealth Advisors. Welcome to our fourth quarter 2023 market update. Today, I am going to try to answer the question of why would a rational investor take the risk of investing in stocks and bonds, given that you can now get over 5% in short-term money markets, CDs, or treasuries. I think it's a great question to ask, given that according to Bloomberg, there is over $5.5 trillion currently sitting in short-term money market accounts, presumably earning somewhere around 5%. So to answer this question, I'm going to share a couple of slides. Okay, this information is as of JP Morgan Asset Management and as of September 30th, 2023. First slide is the same slide I showed on the last video update, which is the Fed funds rates. As you can see here, the Federal Reserve, started raising rates from close to zero and has gone up to over 5% recently. So that's why CDs, money markets, and treasuries are currently yielding over 5%. As you can see, you need to go back almost 20 years to be able to get that type of return in short-term CDs, money markets, and treasuries. So again, I ask the question, why would a rational investor take the risk of investing in stocks and bonds if you can make over 5% in those types of investments? Let's take a look at historically how people have done in similar time periods. So this slide here is showing us 6 different previous time periods where 6-month CD rates, certificate of deposit rates, had peaked. And assuming that rates have peaked now, which we're probably close to that, if not at that level, how did stocks and bonds do 12 months later after those previous periods? So I'm going to look here at the Bloomberg US Aggregate Index, that's bonds. And I'm going to look at the S&P 500 for stocks. I'm going to ignore this middle blue US high yield, which is otherwise known as junk bonds. So let's go through a couple of these periods. In 1984, before my time, investors could get over 10% on a 6-month CD at the peak. 12 months later, bond funds, let's say, US Aggregate Bond Index was up 30%. In this period, 12 months later, up 12%, up 18%, up 13%, up 6%, and up 9%. So in all of those previous 6 periods where 6-month CD rates had peaked, bond investors did better than that going out 12 months. Let's take a look at the same thing for stocks. 1984, 12 months later, up 24 in stocks, up 19 in stocks, up 38 in stocks, down 11, up 21, and up 31. So 5 out of those 6 periods, stock investors did better than CDs 12 months later after 6-month CDs had peaked. So I am certainly not saying that investors should not consider short-term investments like money markets, CDs, and treasuries. I think that's a great place for most investors to have some of their money. What I am saying is for longer-term oriented investors, with history as our guide, longer term, bonds and stocks have both done better than short-term CDs by going out a little further in time horizon. I hope this helps. If I can answer any questions, please don't hesitate to reach out at rob.carrig@stewardpartners.com. Thank you.